The most discouraging phase of investing is not the crash. It is the beginning. That is the stage where almost nobody congratulates you, almost nobody envies you, and almost nobody can see what you are trying to build. You put money in, you check the balance, you do the arithmetic in your head, and what do you find? A number that still feels small, a number that does not look life-changing, a number that can be swallowed by one ugly repair bill, one medical surprise, one foolish shopping season, or one bad emotional decision. That is why so many people quit before compounding ever gets a fair chance to reward them. They do not quit because compounding failed. They quit because the early stage feels insulting. I know that feeling very well. People hear about compounding as if it were a magical force. They are shown dramatic charts. They are told about million-dollar outcomes, retirement balances, passive income, and how money can eventually work harder than labor. All of that can be true. But the truth is incomplete if nobody also tells you what the first stage feels like. The first stage feels slow. The first stage feels thankless. The first stage feels as though you are carrying the whole machine on your back while the machine contributes almost nothing. That is the honest beginning. I have spent most of my life studying businesses, capital allocation, markets, and human behavior. The more I have learned, the less I believe that the real enemy in investing is volatility alone. Often the real enemy is disappointment, not the large theatrical kind, the quiet kind, the kind that makes a sensible person look at 5 years of steady investing and think, is this really doing anything? That question matters because it arrives right at the moment when many people are closest to the edge of a breakthrough they cannot yet see. A woman I know once described this stage perfectly. She had been investing for years, every month, no drama, no genius, just a repeated transfer into a sensible set of holdings. She was not reckless. She was not gambling. She was doing what the books and experts tell ordinary people to do. Yet when she opened her account one evening, the feeling that came over her was not pride. It was irritation. She looked at the number and thought, after all this time, this is it. That reaction is far more common than the industry likes to admit, because the industry loves selling the destination. It is less interested in describing the psychological toll of the road. The road matters. If the road is misunderstood, people abandon it. So let me tell you how I would explain it if I wanted someone to stay in the game long enough to actually benefit. I would say this: compounding is not linear. It is not supposed to feel fair at the beginning. It is not a salary. It is not a vending machine. It behaves more like momentum. And momentum is always hardest to create before it exists. If you have ever tried to push a stalled car, you already understand the shape of the problem. At the start, the effort feels absurd compared with the visible movement. Your legs burn, your hands strain, the vehicle hardly seems to care that you are suffering. Then, at some point, the thing begins to roll. Once it is rolling, the same effort produces a very different result. The motion starts helping you. What looked inert begins cooperating. That is what investment compounding feels like over time. The terrible error many people make is walking away during the pushing stage because no one told them how long the pushing stage usually lasts. So if I were giving somebody a serious framework, I would not merely say be patient. That phrase is too vague to be useful. I would give him a structure, a framework with enough clarity that when discouragement arrives, he can say to himself, this is still within the normal path. The framework I like can be remembered simply. 7531. Not because simple numbers are magical, because clear structure helps people survive what emotion would otherwise sabotage. Let us start with 7 years, is the first serious threshold. I am not saying nothing good can happen in 1 year or 3. Good years happen, great years happen. But if you want to know when investing usually stops feeling like random short-term emotional weather and starts feeling like a real long-term machine. 7 years is the earliest stretch I respect. There is a reason for that. The stock market is noisy over short periods. It can make smart people feel stupid and foolish people feel brilliant. A 1-year result proves almost nothing. A 2-year result proves a little more, and still not enough. Even a good 5-year run can leave a person with the wrong lesson if it happened during particularly favorable conditions. 7 years begins to smooth the emotional chaos. It is long enough to experience a disappointment, a recovery, a stretch of boredom, and often at least one moment when you are tempted to conclude the whole process is broken. That matters. Because investing is not only about return, it is about surviving enough conditions to learn what normal really feels like. I have seen younger investors treat 1 or 2 bad years as though the market personally insulted them. That is childish thinking. Though I understand why it happens, most people have never been trained to think in cycles. They have been trained to think in pay periods. Something remains or does not remain. The market operates on a very different rhythm. It asks for a longer loyalty than most daily life teaches. 7 years gives the process breathing room. 7 years changes the psychology as much as it changes the math. When someone commits to 7 years minimum, the mind starts asking better questions. Instead of asking, why did my account fall this quarter? You begin asking whether my process is still sound. Instead of asking, why am I not rich yet? You ask whether the engine is accumulating. Instead of asking whether this month felt rewarding, you ask whether I am still planting where growth is likely over a much longer horizon. That is a more adult way to think. And adult thinking is a tremendous asset in finance. Now I want to be clear. 7 years does not mean do nothing blindly for 7 years. It means do not expect a serious compounding machine to reveal its beauty on a much shorter emotional timetable. The second number is 5 categories. Not 5 random tickers. Not 5 things you bought because someone on the internet sounded excited. 5 distinct buckets that perform different jobs inside the same portfolio. This is where many people make a bad mistake. They hear the word diversification and think it means owning many things. That is incomplete. Owning many things that behave almost identically is not real diversification. It is crowding. Real diversification means owning categories with different roles, different risk exposures, and different reactions to changing conditions. If I were building a practical long-term portfolio for an ordinary disciplined investor, I would think in 5 broad groups. First, broad market ownership. This is the foundation. Large, productive, diversified businesses. The great wide engine of enterprise, index funds, or broad market funds exist for a reason. They let you own a vast productive machine without needing to pretend you can identify the one company that will dominate the next decade. For most people, this should be the largest slice. It carries growth. It carries the long arc of capitalism. It is not exciting enough for people who want stories, but it is exactly exciting enough for people who want results. Second, dividend-oriented or cash-generative businesses. This is not because dividends are magic. It is because businesses that repeatedly throw off cash and return some of it to owners often have qualities worth respecting. They can add a different rhythm to the portfolio. They give you a sense of cash return even when prices look dull. Later in life, they can become especially useful when income matters. The point is not to chase yield foolishly. The point is to include a sleeve of ownership where the business model itself is sturdier, often more mature, and less dependent on everyone dreaming about a distant future. Third, smaller companies with more room to grow. This is where volatility is higher and patience is more heavily tested. Smaller companies can disappoint violently. They can also outperform over very long stretches because they are not already finished stories. I would never build a whole life around this category, but I would absolutely respect its place. A portfolio without any exposure to smaller growth-oriented businesses may be safer emotionally and poorer mathematically over a long enough horizon. Fourth, international exposure. Home bias is a powerful thing. People like the market they recognize. Fine. Recognition is not a sufficient investment principle. The world is bigger than one country, even a great one. Different regions move through different cycles, different currencies, political structures, and economic mixes create different opportunities and risks. International exposure is not there, so you can sound worldly. It is there because concentration in one geography can quietly become a blind spot. Fifth, defensive reserves. Here I mean things that are not designed to win beauty contests in bull markets. Cash reserves. treasury bills, short duration, defensive assets. Sometimes bonds, though I prefer caution in how that exposure is structured. The job here is not glory, the job is resilience. When the market turns ugly, defensive reserves keep you from feeling cornered. They provide optionality. They create emotional stability. They allow you to buy when everything else feels threatening. This 5-part structure matters for one giant reason. Compounding only works if you remain in the game. If your portfolio is built in such a narrow, fragile way that one ugly cycle or one hot idea turning cold causes you to abandon the whole project, then the mathematics never get time to help you. People underestimate how much good diversification is actually emotional engineering. It is not only about optimizing return, it is about reducing the odds that you will commit self-destruction at exactly the wrong time. That brings us to the third number, 3 emotional phases. If you do not understand these phases, you may mistake them for signs that your strategy is failing, when in fact they are often signs that your strategy is simply being experienced. Honestly, the first phase is doubt. Doubt lives in the early years. You are investing. You are trying, you are being more disciplined than many people around you. Yet the numbers still feel too small. The gap between effort and visible reward bothers you. You see someone making quick money in something speculative and start asking whether you are too conservative. You begin wondering whether intelligent investing is really just a polite way of saying slow disappointment, that is doubt. Doubt is dangerous because it whispers rationalizations that sound intelligent. It says perhaps I should be more aggressive, perhaps I need the right stock, perhaps I am being left behind. Perhaps this is for people who already have money, not for people trying to build it. That voice has ruined many portfolios. The second phase is frustration. This one tends to arrive after the initial idealism wears off. You have been doing the right things for several years. The account is bigger, yes, but not yet inspiring. You feel the weight of your contributions more than the thrill of your returns. At this stage, people become vulnerable to diversion. They do not always blow themselves up in dramatic ways. Sometimes they simply interrupt the process. They stop contributing for a while. They raid the account for a car. They decide a trip now matters more than momentum later. They redirect money towards something that feels more tangible, because the quiet grind of investing has become emotionally irritating. This is often the exact stage where patience would soon start getting paid better. That is the cruelty of compounding. It looks most disappointing right before it begins to feel less disappointing. The third phase is panic. This is the one everyone talks about, and still almost no one truly prepares for. Markets fall, sometimes violently. The account drops below a recent high, sometimes below what you felt it deserved, sometimes even below what you yourself contributed over a certain stretch. Fear arrives dressed as prudence. It tells you that getting out is intelligent. It tells you you can always come back later. It tells you the situation this time is different. Sometimes the facts are different. The emotional structure is not panic, convinces people they are protecting themselves while they are often doing the one thing that permanently damages them. I cannot count how many times I have seen someone survive the slow, boring years only to sabotage himself in the crash year because he had never decided in advance what crashes are for. Crashes are not pleasant. They are also not strange. They are part of the price of admission. That is what history teaches anyone willing to study it without melodrama. If you know these 3 emotional phases are coming, you stop treating them like unique private evidence that you personally are unsuited to investing. You begin to see them as weather fronts, unpleasant. Yes, but expected. Something to be endured within a structure rather than interpreted as a revelation. And that is precisely why I care so much about systems. You do not survive doubt, frustration, and panic by heroically reinventing yourself in each moment. You survive them by deciding in advance how you behave. Do not check the account daily, automate contributions. Rebalance on schedule, not mood, track shares and contributions, not only fluctuating market value. Study history, so the crash looks familiar rather than apocalyptic. Keep reserves so you do not have to sell what should be held. All of these are ways of pre-deciding that the future will not be governed by the most frightened version of you that leaves the final number. 1 annual increase. This is where slow compounding begins, turning into something much more powerful than mere discipline alone. A lot of people treat their monthly investment amount as fixed. They choose a number, congratulate themselves for choosing it, and then leave it untouched for years. That is understandable. Life is busy. A static transfer feels clean. But static contributions often produce a static emotional experience. The account grows, yes, but more slowly than it could because your inputs never adapt to the fact that life usually changes. Income changes, debt gets paid off. Raises arrive, bonuses happen, expenses shift, habits improve. If your contribution never rises, then you are leaving one of the most powerful compounding levers unused. The beauty of a yearly increase is that it can be small enough not to hurt and large enough to matter enormously over time. A 5% increase in contribution does not feel heroic. That is why it is so good. Heroic plans tend to die young. Small annual increases tend to survive. Suppose someone invests $300 per month. A 5% increase is $15 extra the next year, then a little more the year after that, then more again. None of it feels cinematic, yet over 20 or 30 years the difference becomes extraordinary because you are not only compounding returns, you are compounding your own commitment. That is one reason the people who become truly wealthy through ordinary disciplined investing are often not the people with the most dramatic initial contributions. They are the people who never stopped nudging the machine higher as their capacity improved. This also creates a valuable habit of identity. Every year you are telling yourself that the future deserves a slightly larger claim on your earnings than it had last year. That matters. It keeps lifestyle inflation from swallowing the entire benefit of progress. The world constantly invites you to increase visible living when income rises. Nicer apartment, better car, more subscriptions, better furniture, more eating out, more everything, fine. Some improvement is reasonable. But if every raise becomes immediate consumption, then your future remains a beggar standing outside the house while the present keeps throwing itself a party. Annual contribution increases reverse that pattern. They tell income growth, some of you belongs to tomorrow first. That is how ordinary people build extraordinary outcomes without needing extraordinary luck. So now let me show you what all 4 pieces do together. 7 years keeps you from demanding immediate proof from a long-term process. 5 categories keep you diversified enough to survive the road. 3 emotional phases keep you from misreading normal discomfort as strategic failure. 1 annual increase keeps the engine strengthening instead of merely idling. That is a practical system. Not a slogan, not an internet mood, a system. And systems are what I trust. I do not trust the excited version of anyone, myself included, nearly as much as I trust a durable system. Excitement comes and goes. Life interrupts. Markets frighten. People drift, systems hold. Let me go back to the sort of person who begins this process in frustration, because that is where many people are when they need this framework most. She has been investing steadily. She looks at her balance and feels underwhelmed. She wonders whether the account size after years of discipline is embarrassingly small relative to the effort. Fine. I would tell her that the account is not yet supposed to be glamorous. It is supposed to be alive. That may sound modest, but it is not. An alive account is one that is fed, protected, diversified, automated, and left unmolested long enough to become meaningful. The early balance does not need to impress a stranger. It needs to survive your own impatience. That is the real battle. People talk about beating the market as though it were the great feat. For ordinary investors, the greater feat is often beating themselves, beating the part of themselves that wants visible reward too early, beating the part that wants to tinker constantly, beating the part that cannot stand boredom, beating the part that confuses activity with intelligence, beating the part that treats every downturn as a moral emergency. Once you understand that, the whole game changes. You stop asking only how much return did I get. You start asking, did I remain the sort of investor who can actually collect return over long enough periods? That is a much more serious question. There is another layer here that deserves attention. compounding does not only change your account, it changes your character, if you let it. A person who learns to think in 7-year blocks becomes calmer in other parts of life. A person who builds across 5 categories becomes less vulnerable to all or nothing thinking. A person who prepares for the 3 emotional phases becomes less shocked by adversity. A person who increases contributions every year becomes more intentional about the relationship between present comfort and future freedom. The money grows, yes, but so does the operator. That is one reason I like long-term investing as a life teacher. It punishes childishness and rewards steadiness. It teaches you that the visible world often overpays excitement and underpays patience in the short run, then reverses the judgment over the long run. There is real wisdom in that. Now, because people often say this framework sounds good but still feels too slow, I want to say something plainly. You are not racing the person who got lucky in one season. You are not racing the man who made a spectacular trade and will never be able to repeat it. You are not racing the internet highlight reel. You are racing your own tendency to quit too early. That is the only race most people need to win. Let the gamblers have their adrenaline. Let the speculators have their stories. Let the crowd keep searching for the shortcut, dramatic enough to excuse them from patience. You do not need their emotional life. You need their capital only if they insist on donating it to your future through bad decisions. And that does happen over time. Every great transfer of wealth contains an emotional component. One group gets bored, frightened, or greedy. The other group remains structured. The second group tends to own more in the end. This is why I say wealth is built not only by return, but by endurance. Endurance through the slow phase, endurance through the comparison phase, endurance through the first crash, endurance through the years when your contributions seem to matter more than your gains, endurance through the long middle stretch when no one sees anything glamorous happening. That is the real work. And then, if you have done that work, one day the numbers do start changing character. The annual market movement becomes larger than the annual contribution, then larger still. Eventually, the account begins having seasons where the underlying machine seems finally awake. It is not really sudden. It only feels sudden because the first years were so quiet. That is the flip people talk about. Not a miracle. A threshold. A threshold most people never see because they leave during the pushing stage. I want to end with something practical. If I were implementing this right now, I would do the following. First, I would make a 7-year promise in writing. Not to a television personality, to myself. I would say, this capital is not to be judged on a 1-year emotional standard anymore. Second, I would inspect the portfolio, honestly. Do I really have 5 distinct roles represented, or have I mistaken a pile of similar risk for diversification? Third, I would write down how I intend to behave in the 3 emotional phases. What will I do when I feel doubt? What will I do when frustration arrives? What will I do when panic tempts me to sell safety for regret? Fourth, I would set one automatic yearly increase now while I am calm, even if it is small, especially if it is small. Small is what survives, and then I would protect the whole machine from unnecessary interference. The account does not need my daily opinion, it needs my durable loyalty. That is the whole thing. Investing feels boring when misunderstood and profound when understood correctly. It feels broken in the beginning because the beginning is paying for later. It feels slow because speed in compounding belongs mostly to those who stayed through the slow years. And it feels unfair because the market does not pay patience in monthly emotional dividends. It pays later. That is why the 7-5-3-1 structure matters so much. It gives shape to a process that otherwise feels like blind waiting. You are not just waiting, you are crossing a minimum time threshold. You are building real diversification. You are naming the emotional enemies in advance. You are increasing the fuel source every year. That is not passive. That is intelligent long-range construction. Anyone can get excited about a hot tip. Far fewer people can quietly build a compounding machine and leave it alone long enough to become powerful. Be one of the fewer people that is almost always a very good trade. Because if you do, the day eventually comes when the account that once felt embarrassing begins doing something different, it begins carrying part of the load, then enough of it that you finally understand the old promise was not false. It was simply early. And if you remember that when the beginning feels dull, you will already be ahead of most people trying to build wealth. Not because you know a secret, because you know what stage you are in. That clarity alone can save years of self-inflicted damage. And in investing, years are the raw material from which all